Hi, this is Ann with Finance on the Offense, and today I'm going to go over what exactly a share of stock is. All right, let's get started. Okay, so a share of stock represents ownership equity in a company. So basically, if you buy a share of Tesla stock, you own a tiny bit of Tesla, the company. Now, to make it easy, let's say you bought a share of Tesla stock back in January 2020 when it was at right around $100 a share. So to do that, you would have started a brokerage account at one of the brokerage firms like Schwab or Fidelity. Then you would have given them $100 and asked them to go buy a share of Tesla for you. It's actually a lot easier than that because you can just do it all online pretty quickly. But the point is, you can't actually go to Tesla, the company, and buy a share of stock from Tesla. You have to go through a brokerage firm like Schwab or Fidelity. So anyway, you have your one share of Tesla in your account, and you can see the price going up and down over time. Now, because you own a piece of Tesla, you get certain benefits. You're a shareholder, and shareholders have voting rights. So if the board of directors wants to hire a new CEO or something like that, they will send a piece of mail to your house that says, "Do you want this to happen? Yes or no?" And you can fill that out and mail it back if you have an opinion on that. Another benefit is that you get invited to the annual shareholder meeting. Now, I've never gone to one of these. I guess they sound cool, but it's not really my thing. The third benefit is that you get a claim on corporate earnings, and this is usually in the form of dividends or capital gains. And now you're probably like, what in the heck did I just hear? I have no idea what that stuff means. Well, it basically just means from time to time, if the company's doing well, you'll notice they put a little bit more money in your account. Now, if you only have your one share of Tesla at $100, the amount that they give you in the form of dividends and capital gains is not going to be very much, because the amount they give you is a percentage of the value of your shares. But if you had 100 shares that were valued at $10,000, the dividends and capital gains, or the extra money they put into your account, can be a little more impressive. So you have your one share of Tesla, you paid $100 for it back in January of 2020, and then you decide to go look at your account, and let's say you did this about a week ago, which is September 10th, 2021, and you notice that instead of $100, your one share is now worth $733. So you might be thinking, maybe it's time to sell that share. So you do that, you sell it. And by the way, selling a share is a pretty easy process. You just tell your brokerage firm, hey, sell that share, and then they do that for you. And sometimes it's not exactly the going rate. So instead of $733, it might be like $732.85 or something like that. But it's generally pretty close. And by the way, all of that is an automated process too. You don't actually call up your broker. That was what you used to have to do before the internet came along and made everything so easy for us. Anyway, you sell the share and you end up with a $633 profit. So that is awesome. Now, I do want to say, if you sell a stock within a year of buying it, there are some capital gains implications, and that's something I'm not really going to cover, but I wanted you to really be aware of that. Now, let's say the opposite happens and you notice that the stock price of Tesla has been going down every single day for the last 6 months. You see your $100 falling to $75 and then to $50 and then to $40. And so you're probably thinking, well, I need to sell this before I end up with zero. So you go online and you sell the stock and you end up with $40, basically losing more than half what you put in. So these two scenarios are very possible when you're buying stock. In the first scenario, when things are going great, it's actually pretty hard to sell because it's been going great for so long that you just keep thinking that it's going to continue to go great, and you don't want to miss out on, the gains past that point. If you sell, the run is done. And maybe in the second scenario, you see it falling and falling, but you think, well, it's going to recover, so I'll just hang on, and maybe it does recover. There really is just no way of knowing what's going to happen with a stock on any given day or year. Now, whatever happens, if you own a share of a company and the share price goes to $25 or $500, you still own that one share of the company. And there are a couple exceptions to this. For example, a company can go bankrupt. In that case, you'll probably still own the shares, but they'll be worthless. Another exception is a stock split or a reverse stock split. And if you want to learn more about those, I also have another video about those that you can check out. So I like to think of shares kind of like shovels. So let's say you're in the shovels business. You want to buy your shovels when they're super cheap, really low, and when nobody else wants them. And then when you go to sell them, you want to wait till the price is really high so you can get the best profit. So basically, buy low and sell high. The same is true for shares when you're buying them or selling them. Of course, regarding the decision to buy shares, there's a lot more involved than just buy low and sell high. All right, so I hope you have a much better understanding of what a share of stock actually is. And if you like this video and you want to see more videos like this, just hit the subscribe button and the little bell next to it, and you'll be notified every time a new video comes out. All right, I'll see you in the next video. Thank you.